Hey there, welcome to a new video from me. This time I would like to show you a little bit more about Ahold Delhaize and why I like it. It's a Dutch grocery chain which has also a large presence in Belgium and the United States. It's currently trading around €23 and the dividend yield is almost 4%, so I find this an interesting candidate for my portfolio. I recently actually added some additional shares to my portfolio and today I will show you why. But if you don't know me yet, I'm European DGI. I have a blog at www.europeandgi.com on which I write twice a week about dividend growth investing with a European flavor. But hey, let's get started. Let's have a look into Ahold Delhaize. So Koninklijke Ahold Delhaize is commonly known actually as Ahold Delhaize, but it earned its royal status in the Netherlands because it's already more than 100 years existing and contributing to the Dutch society. But it's actually a business that consists of supermarkets, convenience stores, hypermarkets. It has an online grocery, but also actually one of the biggest online non-food store called bol.com in the Netherlands, which is a real competitor of Ahold Delhaize. So if you look at their brands, it's actually quite interesting. So if you're from America, you probably know, if you're specifically living on the East Coast, Food Lion. And Albert Heijn is the Dutch version of Food Lion. It has a large penetration in the Netherlands, it's market leader. It has more than 1,000 stores. But actually for the Dutch people now that are listening, that are really familiar with Albert Heijn, did you know that Food Lion has as well more than 1,000 stores? And this is actually one of the reasons why when many people talk about Ahold, that when they hear that Ahold gets only half of their revenue from Europe and Netherlands and Belgium, that they are surprised because the other half is coming from the United States. There is some history around this in the United States as well, because I think it was back in 2002 or 2003 that there was a big scandal because the board of directors at the time, they were, let's say, bumping up the earnings a little bit that came from the States. So they were cooking the books. And if I'm correct, 4 out of those directors, CEOs, at least got, sentenced, I think. I don't know if they ended up in jail, but yeah, it didn't look good for them. But other brands that you might be familiar with, is, if you're from Belgium, is the Delhaize chain. And this is the company that actually Albert Heijn merged with back in 2016. And you will see later also in the numbers when I go through it that there was quite a big bump in there. But also Gal & Gal is quite a famous shop in the Netherlands. It's really there where you want to buy your wine and your liquor. Ethos is more like, a store where you can get your daily shampoos and all these kinds of cosmetics. It's really such kind of store. I forgot the English name about it. So as you see, it is actually quite well diversified. I think it has like 23, 24 brands, which are all contributing to the bottom line of the company. When you then look at their strategy at the moment, because I also want to first look a little bit into the business of Ahold, their strategy is, when it comes to growth, is really embracing the omni-channel experience. What it means here is that if you want to buy some food from the supermarket, that you can already, for instance, order it online and then pick it up in the shop, or they will deliver it to you. I know there's the Albert Heijn is a famous app which lets you actually walk through the store and that you can pick up and exactly see where the things are lying. So it creates like a nice walkthrough through the shop for you. But at the same time, so this is about omnichannel. At the same time, they're also trying to double down on the healthy and sustainable living. What is good to know that they're doing quite well in Europe, but not too long ago there was a big, reputational issue in Asia because they were selling caged eggs. I don't remember exactly which country in Asia, while they were promoting as part of ESG and everywhere that they were always having non-caged eggs that they were selling. So I think they're trying to do it, but they're definitely not there yet. And from what I understood, it has really to do also with the supply chain. It isn't easy to move away from certain old habits and old behaviors if it's so ingrained in the supply chain. But I would like to see Ahold step up a little bit more there and do more effort to, for instance, not discriminate people in Asia as well from that perspective. If we then briefly look at the 2020 highlights, because they just reported their earnings, what you can see is that there was a major bump in net sales last year due to COVID-19. People have been just stocking up goods, as we all are aware of. And you can see since 2016 till 2019, it grew from 62 billion to 66 billion, now a major bump up to 74 billion. And you see this as well in the consumer online sales. I think it might maybe not sustainable to have all the sales again as per COVID-19. We were literally locked down, but I think a large part of this is there to stay because people now got into the habit of buying online goods. And the same is for the free cash flow. It went to 2.2 billion, not that much higher, but we'll also later see why that is. But I think the biggest news for all of us is that they bumped up their yearly dividend with 18% to 90 cents per share. If you go to the morning stars of this world, you will see 94 cents or something around €1. Don't be confused with that, because we're talking here about fiscal year earnings, not calendar year earnings. And they pay an interim dividend and a final dividend. It's not necessarily consistent, but over the years, over the fiscal years, it's consistent. It's really important to know that, because I think many people get confused by that. And if you will now go online, you will see that maybe the dividend is more than 4%, but it isn't. The dividend yield is at the moment 3.9%. So that's quite important to recognize. But hey, now that we are here, let's also then have a look at the Q4 earnings to zoom a little bit in. So what I find really interesting here is that they had a really high sales last year. And this is where you see when a well-run business is taking these as opportunities, because their EPS here is just minus 1 cent. But why is that? You will see that here. They had a total of 609 million pension plan withdrawal. So what they have effectively been doing is looking at their balance sheet and starting to withdraw a little bit from the pension plans so that they actually deleverage their balance sheet. And that's what they've been doing here. So what you get then is a technical loss in Q4, which means that the full year earnings are €1.30. But if you now then take that out as a one-off, for instance, you get to €2.26, which is really great. And remember, I just mentioned that the dividend was 90 cents, so the dividend is still very well covered. I think this is important to know when you look at the numbers, because I always pay attention to this. Why is there such a big gap? And this is the main reason of why there was a strong impact on EPS. But I find it really clever, because as you will see, in general, this company is quite conservative. Later also, I will show you the estimates. And it's using an excessive amount of cash coming in and earnings to do something smart and deleverage the balance sheet. So I'm really happy with that they've done that. Now was the perfect time if you ever want to do this. So if we then go to their annual report, what I also would like to show you is their multi-year overview, because this was 1 year. It was a bit of an extraordinary year, but I think it's really important to see the growth trends. What you can see clearly here is what I mentioned earlier, is that the acquisition from Delhaize was done. So you see suddenly we go from 32 billion in 2014 to almost 62 billion in 2017 for a slow growing company. Well, this has all to do with the Delhaize acquisition. What I think is also good to see is that if you look at the earnings, it has been quite stable over the years. Yeah, and while they have been buying back shares, so what you see is that the EPS in general, the net income per share, was growing. And I love this. So here you can really see the impact, because you can see a small decline in earnings, net income, let's say between 2018 and 2019, but their earnings per share grew because of the buybacks. And they are at the moment buying back shares for the last 3-4 years at 1 billion per year. And this 1 billion equates to approximately 4% per year, because they have a market cap of around 25 billion. So just by not increasing income itself, they are still growing the shares. What is also interesting here to see is then that you see the dividend, and the dividend growth has been really stellar, because just in 2015 it was 52 cents and now it's already 90 cents. So it's really growing with an average above 10% per year, which is really enormous for a company like this. Also, the free cash flow has been quite stable. You see it here, around 2 billion is hovering, and now it was a bit more than 2 2.2 billion. This has also again to do with, although they earned more last year, it doesn't mean necessarily that they didn't have higher costs as well due to COVID-19 because the supply chain costs have increased. Anyway, the dividends are well covered, and 1 billion of share backs is paid out of this cash flow, so they have still quite decent money left for dividends. And even if they would leverage up a little bit, it doesn't impact the company so much. And I'll show you that now on the consolidated balance sheet, because they have been withdrawing effectively cash. So if you look at it from such a point of view, the balance sheet shrunk a little bit because they have been taking out 800 million in cash as well. If you then look at the long-term debt, I think what is important to know here that this is a company that has a lot of capital lease. And the capital lease is really what you see here as the 9 billion figure. This is a different way of accounting. What it means is like effectively the properties and the shops, let's say, that they are leasing it, which gives them also the right to own them later. It's another form of financing. It has a little bit of tax advantages as well. And if they would like to earlier get rid of it, it gives them a little bit more freedom than when they would wholly own it and have to pay it with mortgages. But in general, the long-term debt is 3.9 million here. Having said that, if you look then to their debt to equity, you will see that the ratio later is around 100 because we will count these together and then matching it with the let's say with the equity, and then you get approximately 100%. This is quite good if you would compare it to Walmart and other companies. It's normal for a predictable company like Ahold to have a relatively high debt to equity ratio because it's such a predictable business. They won't fluctuate. Also during crises, they tend to do well. Okay, what I then also wanted to show you is a little bit the forecast, because you might wonder, why did the price drop so much after the Q4 earnings? And it's really simple what I want to show you here. The target for 2021 is a free cash flow of 1.6 billion instead of 2.2 billion. And we just saw that their recent performance was always a cash flow around 1.8 billion to 2 billion. So what they effectively have done, they are targeting for a lower cash flow. And even so, I would like to call out that in 2020, they were targeting a 1.5 billion free cash flow. This to me says that this is a company that uses the UPOT method, which means under promise and over deliver. I wouldn't be surprised if they go above these numbers again, but hey, let's run with this number later when we do our valuation. What's also important to show you is the dividend payout ratio, that their dividend policy says that it's 40 to 50%. But what I also like is that since last year, they started to add that they would like to see year-over-year increase in the dividend per share. It's not in their official dividend policy, but I started to see it lately in these kinds of reports, which gives me a lot of confidence that the board of directors is really seeing this as part of the shareholder returns and also as an investment case for us shareholders. And as you can see here, they are again attempting to buy back 4% of shares. Now, do this another 5 years and you have already 20% of shares shareholder return just by the buybacks. And in this case, for me, these buybacks make sense. Now, if you then think about Catalyst, we spoke a little bit about omnichannel. I just wanted to show you how the Dutch Amazon looks like. It's bol.com. It is important to know that Amazon also entered the Dutch market, and another big competitor is Coolblue, who I believe is aiming for an IPO anytime soon. But I don't see really how Amazon and Coolblue can easily take all the market dominance away from bol.com, because it exists already for 10 years. It's really ingrained in the Dutch culture. So I think this is such a strong brand, and with the whole Ahold Delhaize behind it, I see this online channel still to exist in 5 to 10 years from now. I think it's important to show you because many people are not familiar with it if you're a non-Dutch, but this one is really growing rapidly, and they made a revenue of 4 billion last year, which is already 6-7% of their total sales. So keep that in mind, and it's growing double digits, as you can imagine. So if we then look at the dividend policy, still what I just mentioned, here you can see the dividend policy is to pay out 40 to 50%. We just saw that they also want to grow their dividend year over year. But if you want to have some of Ahold for the dividend still this year, you really need to buy it around 14 April, because after that you will not be able to get this dividend anymore, and you will need to wait till August for I think it's the interim dividend that will then be announced. So now that I've introduced you to the company, shared you some of the Q4 and the most recent earnings, I think it's good to sum it up a little bit and share also with you my valuation, how much I think it's worth, and what my further buying price is for this company. So the dividend history is always a nice chart. I love these. You can see here again, since 2011 to 2020, it just doubled, and the most recent hike was of 18%, was really a blessing for me. I'm really looking forward to the upcoming dividends. You can see here as well that there's a nice consistent growth. The net income had the pension write-off, but if you would add back the 600 million again, you will see that you come to 2 billion net income. The free cash flow is nice. The share count has been really nicely reduced. You can see the bump in 2016 to 2017 because of Delhaize, but after that it has been just reducing again with 3.5% to 4% per year. I love it. If we then look at some of the key statistics, it has now 14 years of dividend growth after it had to cut it due to the accounting scandal. The dividend yield is 3.9% with a dividend growth of the last 10 years. And one of the best ones here is that it's one of those companies with a Chowder Rule of above 12. So it's really in the green zone here. EPS, free cash flow payout, nothing to worry about. Also with the upcoming forecast, according to the company, I think it will still be fine because the company seems quite committed to the dividend. I think it's good to know that their credit rating is Baa1. That's fine for me. And one little small concern I had was the return on invested capital not really being above the weighted average cost of capital, because this is the value creation metric. I've looked into it a little bit. I haven't seen anything that concerns me, but I do treat it as a flag that I would like to see improve in the upcoming years, and the years before it was a bit better, so it might have been a one-off here. So let's then now also look a little bit in my valuation, and before I show the numbers, I will show you the sheet first. So this is my updated discounted cash flow calculation sheet. What you will see here is the ticker. It's listed on the Amsterdam Stock Exchange. It currently trades at around €23, and this is the ISIN ticker in case you want to look it up in your broker and purchase it. So there are currently slightly over 1 billion shares outstanding. I'm using the cash flow that they predict themselves, the free cash flow of 1.6 billion. Again, I wouldn't be surprised if they go over this, but otherwise it serves as a bottom. They have currently 3 billion of cash on hand, and I mentioned to you already 3.9 billion of long-term debt. A market cap of around 24 billion and the earnings share of 2.26, not counting for the pension issues, of course, or the pension withdrawal. So there are 3 cases that I model against. The baseline case is that I think they will grow with 5% in the upcoming 5 years, and then they will grow with 3% going forward. And this is around cash flow, not sales, but cash flow. It's easier to grow your cash flow than your sales from that point of view. And at a discount rate or a cost of capital of 7%. And in the end, I will give the terminal multiple of 14. Now, how that looks like, you will see here the sum of cash flows. If you count this all together, you will see that the sum is around 14 billion. And then if you take the terminal value on top of it, which is 14 times the last one, you get together an intrinsic value of 31 billion. I then add the cash on hand and reduce the long-term debt, which gives me a fair value for the company of 29, or let's say 30 billion, which would be a fair value per share of €28. Again, I do this and give this the probability of 65%. I've done the same for the optimistic case of 7% growth and a bearish case of 3% growth. We don't know what the future will hold, so I would like to model those in. In that case, you will see the different prices, and the lowest is €21. And based on that, if I all sum this up, it gives me a fair value price per share of €27.60. I might be wrong here. For instance, with the capital leases debt, you can argue should you add it or not. I've chosen to take it out for the company because I don't see it as having a marginally impact on the cash flow from that point of view. Hence, €27. But hey, if I'm wrong, my buy price is around €22.08. What's good for you to know is that 2-3 weeks ago, when the price dipped after the Q4 earnings, I bought some shares at €22.50. I don't want to buy straight away again at that price because I don't know what it will be doing. So I might, in my case, add again in the low €21. So now that I have also shared with you how I value this company, I think it's time to round up. I really hope that you found this video informative, that you got a bit of a better introduction and understanding of Ahold Delhaize and how it adds its value to society, which brands it has, how it's performing, how the dividend has been growing, and what my general thoughts are about this. Having said that, thank you for watching. If you like such videos, please hit the like button, subscribe to the channel. It really means the world to me. Feel free to share it as well on Twitter, Facebook, get the word out. I would love to share more European stocks with you. I think they're underserved in the community. So really, if you enjoy these kinds of video, just let me know. And hey, of course, ask me any questions in the comment section. If you don't agree to something, challenge me. It makes me also a better investor. I believe that all together and all the information sharing that we do will make us all better and should give us a lot of wealth. Having said that, enjoy the rest of the weekend and well, be in touch. Ciao.